Hello fellows, welcome to my channel. This channel is created for educational purposes only, dedicated to people who want to learn how to trade. Either you want to trade stocks, crypto, commodities or Forex. You will find high quality educational material. Either you are a beginner, advanced or an intermediate trader. For viewers that want to see more action and how we apply the theory in real trades, you can visit our live channel. Here we are trading our live account and applying the theory, proving that it can be done, while all trading profits go to our subs. However, as a beginner, I do not recommend starting with any real money. Trading is very risky and challenging. However, a risk comes always with a reward. You will find 50 videos to understand the theory, 12 sections. Each section is a playlist consisting of several videos. I do not recommend skipping chapters and trying to take classes from the beginning. We are using verified sources to provide the most accurate information. Remember, this is an educational channel and you will always trade with demos to avoid the risk. Make profits in the market is not the easy passive income you have in mind. The entire material is the same as you will find in most trading courses. The material is totally free and you don't have to pay any guru to learn generic information or waste thousands of dollars. So if you want to support us, subscribe, like and leave a comment for the YouTube algorithm. And you can post your progress in our Facebook page. Thank you very much and trade safe. Understanding the factors that drive the Forex market is essential for successful trading. While technical analysis plays a crucial role, one must also consider the impact of fundamental forces behind market movements, and this force is none other than the news. In the world of trading, just as fundamental force lies behind these movements, the news hold a similar sway over the Forex market. To grasp the importance of news, let's imagine a fictional scenario. You own shares of the largest tech company, and one evening the news reports its bankruptcy. Instantly, your perception of the company changes, and you are likely to react by selling off your shares. Or at least you will try to sell them, as the value will drop significantly. Naturally, others would respond in a similar manner, causing a significant market impact. The reality is that news profoundly influences our trading decisions. This principle is equally applicable to trading currencies, with a notable difference in how news is handled in the stock market compared to the forex market. In the stock market, acting on news before it becomes public knowledge is illegal insider trading. Conversely, in the forex market, it is considered fair game. The speed at which one can access and act on news determines their advantage in trading, and there are no penalties for doing so. In the forex market, news holds immense power, and traders can react swiftly to market speculations due to technological advancements and instant communication. This benefits retail traders as it levels the playing field, allowing everyone to rely on the same news for making trading decisions. Without news, the market would stagnate and technical analysis alone would not be sufficient to drive significant price movements. In conclusion, the forex market thrives on news as its driving force. Understanding and acting on news in conjunction with technical analysis is vital for successful trading, as it provides the necessary fuel to keep the market in motion. As forex traders, staying attentive to major economic data releases, government official speeches, and geopolitical events is crucial. You will find the relevant video on how to use the fundamental analysis. Why is this so important? Because these pieces of information often reflects the strength of an economy and can offer insights into the future direction of a currency. Trading the news can be challenging and might not suit everyone's trading style, but the subsequent volatility can present numerous trading opportunities. So why trade the news? The straightforward answer is to maximize profits. As emphasized in the previous lesson, news plays a pivotal role in the forex market as it has the potential to move the market significantly. When important news is released, it's almost expected to witness substantial market movement. Recognizing that the market is likely to shift presents a promising opportunity worth considering. As new traders, your goal is to position yourself on the right side of these moves. However, it is important to acknowledge the dangers associated with trading the news. As with any trading strategy, some potential risks include spreads widen during critical news events. The forex market becomes highly volatile, leading many brokers to widen their spreads. This can increase trading costs and impact overall profitability. Trading slippage. Extreme volatility can lead to trade execution delays, causing your trade to be executed at a different price than expected. This phenomenon, known as slippage, may result in unintended outcomes. Whipsaw prices moves. News includes market swings, may initially surge in one direction, only to quickly reverse in the opposite direction. Determining the correct market direction can be challenging and lead to potential losses. Trading the news can be unpredictable. It requires extensive practice and a well-defined trading plan. Depends on your trading style. For the short term and readings that do not last more than a day, we recommend avoiding significant news. There will be cases that you will be on a trade and the news will come out. In our live channel, we have an example, even though we didn't know the outcome of the news. After the release, the news was in our favor. This helped us to exit the trade and enjoy a very juiceful trade. While it may not be as easy as defeating a toddler in Fortnite, constant practice is essential to mastering this strategy successfully. In the forthcoming lessons, we will provide with valuable tips on how to treat the news safely and effectively. Before formulating a trade the news strategy, it is essential to identify which news events are worth trading. Understanding the impact of key events risk on a major currency is crucial for forex traders. The primary reason for trading the news is the ability to create short-term volatility, which presents attractive trading opportunities. Naturally, traders prefer to focus on news events that have been highest potential to move the currency market significantly. The news events that typically drive price action and induce volatility markets include changes in central bank policy, shifts in government policy, unexpected results in economic data releases, huge gaps between expected and actual news, random tweets from influential world leaders. Being aware of upcoming key events risks is essential to avoid being caught on the wrong side of the market. To identify events that produce volatility, traders can rely on the economic calendars available to several sites like MyFXBook, Forex Factory, and others. This calendar highlights important events and economic data releases from countries with the most commonly traded currencies. It allows filtering events by their impact, making it easy to focus on those historical known to create market volatility. Some examples of news events that are often impactful includes interest rates decision by central banks, inflation data, CPI, PCE, PPI, employment data, unemployment, wage growth, economic growth data, GDP, retail sales, industrial production, business sentiment surveys, consumer confidence surveys, housing data, sales, construction, trade balance. The relative importance of these events can change depending on global circumstances, make it crucial to stay informed about current market focus. Special attention should be paid to news from the United States, as it significantly influences the forex market. The US remains a dominant financial superpower with the largest economy and the US dollar as the world's reserve currency. Approximately 9% of all forex transactions involve the US dollar, making the US news and data highly relevant to forex traders. Aside from economic data and central bank speeches, geopolitical news such as pandemic, wars, natural disasters, political uncertainties, protests, and upcoming elections can also impact the market. When trading the news, keeping an eye on moves in the US stock market can be insightful, as sentiment in the equity markets can precede major currency market movement. Choosing the right currency pair to trade the news is vital. As a new trader, the two main objectives are to take advantage of short-term volatility and keep transaction costs low. Trading deeply liquidity currency pairs with tight spreads ensures smooth execution of orders and cost effectiveness. Major currency pairs such as Euro USD, GBP USD, USD GPY, USD CHF, USD CAD, and AUD USD are preferred for their high liquidity and tight spreads. Now that we know which news events and currency pairs to focus on, let's explore some approaches to trading the news. When trading the news, there are two main approaches that traders can employ based on their market outlook: directional bias and non-directional bias. Having a directional bias means anticipating the market movements in a specific direction following the release of news reports. Traders with a directional bias analyze news reports to understand what factors will influence market movement. A significant concept to consider is the difference between the consensus and the actual number in the analyst forecast. Before a news report is released, various analysts make predictions, and the common number they agree on is called the consensus. The actual number is the official figure published in the report. The phrase buy the rumor, sell on the news is often used in the forex trading because sometimes the market's reaction doesn't align with the report's implication. Think twice before trading the news. As beginners, we do not recommend to trade during big event releases such as interest rates or non-farm payrolls. For instance, if the consensus suggests an increase in the US unemployment rate, traders may start selling off dollars ahead of the report release, anticipating a weaker US economy and a weaker dollar. However, when the actual unemployment rate matches the consensus, the market may not respond as expected, as the major players had already adjusted their positions earlier. On the other hand, if the actual report reveals a surprise deviation from the consensus, such as lower unemployment rate than expected, the market might witness significant movements as market participants scramble to adjust their positions accordingly. Monitoring both the consensus and the actual numbers helps traders access which news reports are likely to cause substantial market movements and in which direction. On the other hand, non-directional bias. The non-directional bias is a more common news trading strategy that does not rely on anticipating the market direction. Instead, this approach capitalizes on the fact that significant news releases creates substantial market volatility, irrespective of the direction. The key is to prepare to enter a trade once the market starts moving, regardless of whether it moves up or down. In this approach, traders have a plan in place to take advantage of the market movement in either direction, hence the name non-directional bias. The non-directional bias approach allows traders to capture trading opportunities without being limited by a specific market view. The focus is on being present and ready to act when the forex market experiences significant moves triggered by major news events. Now, let's explore how to trade the news with a directional bias. In a trading scenario, we will use the example of the US unemployment rate report to illustrate the process. So, the US unemployment report shows improvement, yet USD weakens. Suppose the USD unemployment rate unexpectedly drops, indicating positive news as more people find jobs. However, upon checking the charts, you notice that the US dollar is actually weakening contrary to expectations. To understand this apparent contradiction, consider the following reasons. Positive employment numbers are temporary. In some cases, the drop in unemployment rate could be due to temporary factors. For example, during the holiday season, companies often hire seasonal employees to handle increased Christmas shoppers. This short-term boost in jobs might not reflect the long-term economic outlook. Overall economic outlook still poor. The drop in the unemployment rate might not be enough to shift the long-term trend of the US economy, which could still be facing challenges. Other fundamental factors play into an economy's strength or weakness, and this positive employment data may not be sufficient to change big traders' perception of the dollar. When trading the news with a directional bias, it's essential to take a step back and consider the bigger picture before making decisions. Now let's focus on how to trade the news with a directional bias in Forex. Using the unemployment rate example, in this scenario, I won't use any interest rates as they are far more significant. Yet, this unemployment scenario makes it easier to understand. Assess the trend before the report is released. Examine the historical trend of the unemployment rate to understand if it has been increasing or decreasing. This analysis will help you prepare the potential future movements. Establish a directional bias. Based on the trend analysis, determine your directional bias. For instance, if the unemployment rate has been rising, you might expect it to continue rising, leading to a bearish outlook on the US dollar. Identify breakpoints shortly before the unemployment rate is announced. Observe the price movement of the USD JPY pairs, for example, for about 20 minutes. Note the high and the low made during this period. as they will become your breakout points and identify a channel. As the market anticipates the news, it will be trapped in a channel. Most of the times. Set entry and exit points. With a bearish outlook on the dollar, focus on the lower breakout point. Set your entry point a few pips before this level as you anticipate the dollar to drop. Place your stop just above the upper breakout point and set your profit target for the same number of pips as your breakout point range. Trade execution. Depending on the news report's outcome, one of two things may happen. If the unemployment rate drops, the dollar could rise, and your trade may not trigger. As the market will be volatile, do not put any tight stop losses and use major pairs. If the unemployment rate rises, confirming your bearish outlook, the dollar could weaken, and your trade will be activated. Again, remember, the effect might be temporary. Break even fast and don't hold it more than a day. Monitor and adjust as your trade progresses closely. Observe the market. If the target gets hit, you successfully capture profits. The key to trading with a directional bias is to have comprehensive understanding of the news reports, potential impacts on specific currencies. By grasping these concepts, you can avoid getting trapped in unfavorable setup and increase your chances of successful trades. Let's see how to trade the news using the Straddle trade strategy. Imagine having a method to profit quickly from the market, regardless of whether it moves up or down. This possibility becomes reality when there is price volatility, often experienced during the release of important news, like economic data or central bank announcements. Remember what we said: interest rates, unemployment rates, CPI, non-farm payrolls, and so on. Goes without saying that this episode is strictly tied with fundamental analysis video you will find in the description. To trade the news effectively, the first step is to identify the significant news reports with the highest potential to move the market. Focus on those releases as they are more likely to generate substantial price movements. Next, about 20 minutes before the actual news release, observe the price range. The high of this range becomes the upper breakout point, while the low becomes the lower breakout point. Remember that a smaller range indicates a higher likelihood of a big market move after the news release. These breakout points serve as your entry levels. Set your orders accordingly, with stop loss orders placed around 20 pips above and below the breakout point. Again, as we said, use major pairs to avoid huge slippage. Additionally, your initial profit targets should be about the same as the breakout range. In our series, we recommend to adjust for higher profits, but this will come in time and with practice. This trading strategy is known as a straddle trade. By trading both sides of the trade, you position yourself to take advantage of the market's movements, regardless of its direction. Once your orders are in place, wait for the news to be released. Sometimes one of your entries may get triggered only to see quickly reversal and get stopped out. Again, break even the soonest is the key. The other entry may still be triggered, and if that trade proves profitable, it can compensate for the initial losses, resulting in a small profit. The best case scenario is that only one of your trades gets triggered and the price continues to move in your favor, avoiding any losses altogether. If executed correctly, you should still end up with a positive outcome of the day. One of the advantages of non-directional bias approach, the straddle trade, is that it removes emotional decision making. The goal is simply to profit when the market moves, allowing you to take advantage of more trading opportunities, since you will be triggered in either direction. As news events typically have limited long-term impact on price action, setting realistic profit targets can increase the number of winning trades. While there are numerous strategies for trading the news, incorporating the concepts discussed in the lesson and into the approach will be beneficial whenever you aim to capitalize on news reports movements. Trading the news can be a powerful tool in your trading arsenal, but it requires knowledge, practice, and discipline. No matter whether the news are adverse or favorable, you should be prepared for both. In this particular trade, in our live channel, I'm long on Euro USD. As I don't know where the market will go and the data will be on my favor, I'm ready to close my position and book some early profits. When the news are released, are on my side. So I readjust my profits to take a bit more from the market, and finally the trade is done and I'm out. Armed with the insights and strategies presented in this video, you will be better equipped to seize opportunities, mitigate risk, and master the art of trading the news for consistent profitability in the Forex market. So, to sum up, understanding the power of news events, learn how major economic data releases affect the market, use the fundamental analysis link that we provided in this video. The two approaches to trading the news, directional bias and non-directional bias. The Straddle trade strategy we described, identifying high impact news reports. The art of reading the consensus versus actual numbers will take time. Setting realistic profit targets. Embracing non-directional bias for emotional discipline. Risk management and trade planning. No trading guide is complete without emphasizing the importance of risk management and trade planning. Learn how to protect your capital and make well-informed decisions to enhance profitability. Thank you for watching. Go back, repeat the chapters you are not sure, and you will find your name in the Arintra supporters. Help us to launch it. You will find more info in the pinned comment. Trade safe. Thank you for watching our videos. I hope you enjoy. You know that we need your subscriptions, likes, and comments for the YouTube algorithm. Help us to make more content and trade safe.